What if I told you that $11,000, right now, sitting in a regular savings account earning almost nothing, could be turned into a machine that pays you every single month without you lifting a finger? That's exactly what dividend investing does. And today, I'm going to walk you through the entire process, from zero to your first dividend payment, using $11,000 as our starting point. We're going to cover what dividends actually are, how to pick the right stocks, how to build a portfolio with $11,000, and, most importantly, how much money you can realistically expect to make. Stick around because near the end, I'm going to show you a real portfolio breakdown. Exactly how I would invest that $11,000 across 5 different positions. Let's get into it. What are dividends? Before we talk about the money, let's make sure we're all on the same page. What is a dividend? When you buy stock in a company, you become a part owner of that business. Now, some companies, especially large, well-established ones, take a portion of their profits and distribute it back to shareholders. That distribution is called a dividend. Think of it like being a landlord. You own the property, and every month your tenant pays you rent. With dividends, you own a piece of a company, and the company pays you a slice of its profits. Here's what makes this really exciting. Dividends are usually paid quarterly. That means 4 times a year. But some companies, especially REITs, real estate investment trusts, pay monthly. So if you build your portfolio strategically, you can set yourself up to receive income every single month. Now, the key number you need to know is called the dividend yield. It's a percentage that tells you how much income you get relative to the price you paid for the stock. For example, if a stock costs $50 per share and it pays $2 per year in dividends, your yield is 4%. That means for every $100 you invest, you earn $4 a year in passive income. Simple, powerful, and it compounds beautifully over time, which we'll get to. The $11,000 breakdown. What $11,000 can actually do? All right, let's talk real numbers. You've got $11,000. What does that actually look like in terms of dividend income? Let's run 3 scenarios: conservative, moderate, and aggressive, based on different yield targets. Now, I know what you're thinking, $27 a month? That's a cup of coffee. Is this even worth it? Yes. And here's why. You're not just earning income, you're building a machine. Every dollar you reinvest through something called DRIP, dividend reinvestment plans, buys you more shares, which pays you more dividends, which buys even more shares. This is compounding in its most powerful form. Let me show you what that $11,000 looks like in 10 years if you reinvest every dividend at a moderate 4.5% yield and the stock grows at just 6% annually. That $11,000 quietly grows into nearly $40,000 over 20 years, paying you over $1,700 a year without you adding a single extra dollar. That's the power of dividend investing. How to pick dividend stocks. All right, now you understand the mechanics. Let's talk about how to actually pick good dividend stocks, because not all high-yield stocks are created equal. Rule number 1, do not chase the highest yield. I know it's tempting. You see a stock with a 12% yield and think you've hit the jackpot. But here's the reality. A super high yield often means the company is in trouble and the stock price has crashed. That's called a yield trap, and it can destroy your capital. Instead, here are the 5 things I look at when evaluating a dividend stock. 1. Dividend yield. 3% to 7% sweet spot. High enough to matter, low enough to be sustainable. Anything above 8% deserves extra scrutiny. 2. Payout ratio, under 75%. This is what percentage of earnings the company pays as dividends. Under 75% means they're keeping enough to reinvest in the business. Over 90% is a red flag. 3. Dividend growth history. Has the company been increasing its dividend year after year? Companies called dividend aristocrats have raised their dividend for 25-plus consecutive years. That's the gold standard. 4. Earnings. Stability. Is the company profitable? Consistent earnings mean consistent dividends. Look for companies in sectors like consumer staples, utilities, healthcare, and REITs. 5. Debt levels. A company drowning in debt might cut its dividend to survive. Check the debt-to-equity ratio, ideally under 1.5 for most industries. Now, where do you actually find this information? Sites like dividend.com, Seeking Alpha, and just Googling the company's investor relations page will give you all of this. Or you can use a brokerage like Fidelity or Charles Schwab, which shows dividend history right in the stock details. The portfolio breakdown. Okay, this is the part you've been waiting for. If I had $11,000 to invest in dividends starting today, here's exactly how I would split it up. I'm going to diversify across 5 categories to balance yield, stability, and growth. Remember, this is not financial advice. These are examples to illustrate the strategy. Always do your own research. Let me walk you through the logic here. The dividend aristocrats, stocks like Johnson & Johnson, Coca-Cola, and Procter & Gamble, are the backbone of this portfolio. They're not the sexiest stocks. They don't 3x overnight, but they have raised their dividends every single year for decades. Rain or shine, recession or boom, that's reliability you can count on. REITs are one of my favorite income tools because they're required by law to distribute 90% of their taxable income to shareholders. Realty Income, ticker O, is famous for paying its dividend monthly and has done so for over 600 consecutive months. That's 50 years of monthly checks. Utility stocks like Duke Energy are what I call boring beautiful. People need electricity whether the economy is booming or crashing. These companies generate predictable cash flow and they pay it back to shareholders reliably. The high-yield ETF slice, funds like SCHD or VYM, gives us instant diversification. One purchase gets you exposure to 50 to 100 dividend stocks. It's a great way to reduce single stock risk. And finally, a small allocation to business development companies or BDCs. These are like the high-yield, high-risk slice of the portfolio. They pay big dividends, sometimes 8 to 10%, but they're more volatile. Keep this position small. Drip and compounding. Now I want to talk about the single most powerful thing a beginning dividend investor can do. And most people skip it. It's called DRIP, Dividend Reinvestment Plan. Most brokerages let you turn this on with a single click. Here's how it works. When your dividend arrives, instead of sitting as cash in your account, it automatically buys more shares of the same stock, even fractional shares. So if you earn $44 in dividends this month and the stock costs $60 per share, DRIP buys you 0.73 shares automatically. Those new shares pay you dividends next quarter, which buys more shares, which pays more dividends. This is a snowball, a slow one at first, but give it 5 to 10 years, and it becomes unstoppable. Here's the critical distinction. Dividend investing is not a get-rich-quick scheme. It's a get-wealthy-slowly system. The investors who get frustrated and quit after 2 years are the ones who miss the magic that happens in years 8, 12, and 20. Warren Buffett, arguably the greatest investor alive, said it best. Someone is sitting in the shade today because someone planted a tree a long time ago. With $11,000 and DRIP turned on, you are planting that tree today. Common mistakes. The 4 mistakes that kill dividend income delivery. Before I let you go open your brokerage account, I want to make sure you don't make the mistakes that destroy beginners' portfolios. These are the big 4. Mistake number 1, chasing yield without checking payout ratio. We already talked about yield traps, but I'll say it again. A 10% yield that gets cut to 2% next quarter is worse than a 4% yield that grows 5% every year. Always check the payout ratio before you buy. Mistake number 2, putting all $11,000 in one stock. Even the most reliable dividend stocks can surprise you. GE paid a dividend for over 100 years and cut it to nearly zero in 2018. Diversify across sectors, company sizes, and geographies. Mistake number 3, ignoring taxes. Dividends are taxable income. Qualified dividends from U.S. stocks held over 60 days get the lower capital gains tax rate, which is 0%, 15%, or 20%, depending on your income. Non-qualified dividends are taxed as ordinary income. If you're in a high tax bracket, consider holding dividend stocks in an IRA or Roth IRA to shield that income. Mistake number 4, turning off DRIP too early. The biggest compounding gains happen when you reinvest for 10+ years. Don't switch to taking the cash payout until you actually need the income, like in retirement. Let it compound. So there you have it. A complete roadmap for turning $11,000 into a dividend income machine. You now know what dividends are, how to calculate yield, what makes a great dividend stock, exactly how to split $11,000 across 5 categories for a blended yield of nearly 5%, how DRIP compounds your wealth over time, and the 4 biggest mistakes to avoid. The best part? You don't need to be rich to start. You don't need a finance degree. You just need the patience to plant the tree and let it grow. If you found this video helpful, do me a favor and hit that like button. It genuinely helps this channel reach more people who are trying to build real financial freedom. And if you want to see the next video in this series, where I'll show you how to build a 50K dividend portfolio step by step, make sure you subscribe and hit the notification bell so you don't miss it. Drop a comment below and tell me, are you starting your dividend journey? What's your first investment going to be? I read every single comment. Until next time, keep planting. See you in the next one.